Section 1. Introduction. Imagine for a moment you're standing at the entrance of Wall Street in the 1940s. Brokers rush through crowded sidewalks, newspapers shout headlines about rising and falling stocks, and the air is thick with both fear and greed. Now picture a man in a simple suit, walking slowly, carrying no flashy briefcase, no gold watch, no air of arrogance. This man isn't chasing quick riches. He's studying, observing, and building timeless principles that would later shape generations of investors. That man was Benjamin Graham. And his masterpiece, The Intelligent Investor, has often been called the single most important book on investing ever written. In fact, Warren Buffett himself once described it as, quote, by far the best book about investing ever written. Buffett, who went on to become one of the wealthiest men alive, credited much of his philosophy to the lessons taught by Graham. But what exactly makes this book so powerful? And more importantly, why decades later, do its principles still apply in our fast-moving, unpredictable world of finance? Welcome to Legacy Book Insight. In today's video, we're going to break it all down. Section by section, idea by idea. We'll uncover the core lessons of The Intelligent Investor, expand on Graham's timeless strategies, and translate them into practical insights you can apply to your own financial journey, whether you're just starting out or already managing your portfolio. So sit back, grab a notebook, and prepare to see investing in a completely new light. Because this isn't about hot stock tips. This isn't about chasing the latest hype. Pause, emphasize, this is about learning how to think like an intelligent investor. Section 2. Investing versus speculating. One of the very first lessons Benjamin Graham teaches us in The Intelligent Investor is the difference between investing and speculating. And trust me, this distinction is not just academic. It's the difference between building long-term wealth and gambling away your future. So let's define it clearly. An investment operation is one which, upon thorough analysis, promises safety of principal and a satisfactory return. Anything else, that's speculation. Notice those words, safety of principal. Graham insists that true investing is not about chasing the biggest possible gains, but about protecting the money you already have and ensuring it grows steadily, even if slowly. Speculation, on the other hand, is when you buy a stock, a cryptocurrency, or any asset, hoping, guessing, even gambling, that its price will rise simply because someone else will pay more later. It's the difference between treating the stock market like a business owner versus treating it like a casino. Now, does that mean speculation is evil or something we should never do? Not exactly. Graham admits that speculation can be exciting, even tempting. But he warns, speculation must never be confused with genuine investing. He even goes so far as to say, if you must speculate, do so with only a small portion of your money and treat it like entertainment money. The same way you'd buy a lottery ticket or visit a casino, not as a path to building lasting wealth. This single lesson, understanding the true meaning of investing, can transform the way you view money. Because when you stop chasing get-rich-quick schemes and instead focus on protecting your capital and earning steady, reliable returns, you automatically begin thinking like an intelligent investor. Section 3. Mr. Market. Benjamin Graham introduced one of the most famous metaphors in investing history. He called it Mr. Market. Imagine this. You own a business and every single day your business partner, Mr. Market, knocks on your door. Some days he's cheerful and optimistic. He offers to buy your share at a very high price. Other days he's gloomy and fearful. He's willing to sell you his share at a very low price. Here's the key, you don't have to accept his offer. You can simply ignore him and wait until his price makes sense. This story is Graham's way of teaching us that the stock market is driven by emotion, fear, and greed. Prices swing wildly, but your job as an intelligent investor is to remain calm, rational, and only act when it benefits you. So instead of being controlled by Mr. Market's mood swings, you use them to your advantage. Section 4. Margin of safety. One of Benjamin Graham's most powerful lessons is the idea of a margin of safety. In simple terms, it means never paying full price for an investment. Instead, you build a cushion of safety by buying below the asset's true value. Think of it like driving a car across a bridge. If the bridge is built to hold 10,000 pounds, you don't want to drive across with a 10,000-pound truck. You want a margin of safety, say 6,000 or 7,000 pounds, to protect yourself from risk. The same applies to investing. By buying stocks at a discount to their real worth, you protect yourself from mistakes, misjudgments, and unexpected downturns. Graham reminds us that we can't predict the future perfectly. But with a margin of safety, we don't need to. We simply prepare, protect, and give ourselves room to be wrong, while still being positioned to win. Section 5. Defensive versus enterprising. Benjamin Graham believed that not all investors are the same. Some prefer safety and simplicity, while others want to be more active and hands-on. The defensive investor is cautious. They don't want to spend hours researching stocks. Instead, they focus on safety, diversification, and steady returns. For them, strategies like investing in index funds, bonds, and large, stable companies make the most sense. The enterprising investor, on the other hand, is willing to put in extra work. They study financial reports, search for undervalued companies, and actively manage their portfolio. They aim for higher returns but accept more responsibility and effort. Your tolerance for risk. Because the true danger is pretending to be enterprising when you don't have the discipline, or settling for defensive strategies while secretly craving excitement. The intelligent investor knows themselves first and invests accordingly. Section 6. Emotional discipline and investor psychology. Benjamin Graham understood something most people ignore. The biggest threat to your wealth isn't the stock market. Pause, it's your own emotions. Fear and greed are the two forces that push investors into making terrible decisions. Fear makes you sell too quickly during downturns. Greed makes you buy overpriced stocks when everyone else is excited. Graham insisted that an intelligent investor must develop emotional discipline. That means sticking to your plan even when the crowd is panicking or celebrating. When markets crash, many investors panic sell at the bottom. But the intelligent investor sees it differently. Downturns are opportunities to buy great companies at discounted prices. And when markets are soaring, instead of chasing the hype, the intelligent investor stays cautious, remembering that prices eventually swing back to reality. In short, your behavior matters more than your IQ. It's not about outsmarting the market, it's about outlasting your emotions. Section 7. Risk, volatility, and long-term thinking. Most people think risk means losing money. But Benjamin Graham taught us something different. Risk isn't just about short-term price swings. Risk is the chance of permanent loss. That's why he told investors not to panic when prices go up and down. Volatility is normal. It's simply the market's mood swings, just like Mr. Market we met earlier. If you zoom in too close, every dip feels terrifying. But zoom out to the long term, and you'll see that patient investors who stay disciplined often come out ahead. The intelligent investor uses time as their ally. They understand that markets rise and fall, but quality businesses bought at fair prices tend to grow in value over years and decades. So instead of trying to predict the next crash or the next boom, you focus on what you can control, buying wisely, diversifying, and holding for the long term. Section 8. Benjamin Graham's legacy and modern applications. Benjamin Graham passed away in 1976, but his influence is everywhere. His students, like Warren Buffett, Charlie Munger, and many others, carried his teachings into the modern age. But you may wonder, do his lessons still matter in today's fast-paced world of technology stocks, index funds, and cryptocurrencies? The answer is yes. In fact, they matter more than ever. Because while markets evolve, human behavior does not. Fear, greed, overconfidence, and impatience still drive prices up and down, just like in Graham's day. His principles, margin of safety, discipline, and long-term thinking, remain timeless tools for protecting and growing wealth. Take index funds, for example. Graham strongly recommended them as a tool for the defensive investor, decades before they became mainstream. Today, they're one of the simplest and most reliable ways to build wealth slowly and intelligently. Or consider the explosion of speculative assets like meme stocks and crypto. Graham's warnings against speculation apply perfectly. Don't mistake gambling for investing. In other words, technology changes, markets shift, but the core principles of intelligent investing never go out of style. Section 9. Closing and call to action. So, what does it really mean to be an intelligent investor? It means knowing the difference between investing and speculating. Pause. It means ignoring the mood swings of Mr. Market. It means protecting yourself with a margin of safety. It means choosing the path, defensive or enterprising, that fits your life. It means controlling your emotions, thinking long-term, and focusing on what you can control. Most of all, it means building wealth patiently instead of chasing quick wins. Benjamin Graham gave us timeless wisdom. And if you apply even a few of these principles, whether it's investing through index funds, holding a disciplined portfolio, or simply avoiding speculation, you'll already be far ahead of the crowd. Now, I'd love to hear from you. Which of these principles spoke to you the most? Do you see yourself as more of a defensive investor or an enterprising one? Drop your thoughts in the comments below. And if you found this breakdown valuable, don't forget to give this video a like, share it with someone who's on their investing journey, and subscribe for more deep dives into the world's most important financial books. Until next time, invest wisely, stay disciplined, and think long-term. Thanks for watching.